So if you're cutting CapEx by $4 billion this year, where are you going to cut it?
Well, good morning, Alix, and it's good to see you. First of all, as we go through this, I just want to continue to express my support for all the people who are fighting this disease and the first responders and healthcare providers that are on the front line. We're looking at our business and adjusting to an environment where we see supply and demand changing dramatically. We announced some changes today to reduce our capital spending by about 20% or $4 billion. That actually means as we get to the end of the year, our spending rate will be down 30%, which would imply a cut of more like $6 billion as we exit the year, distributed across our portfolio, but the largest single piece in the Permian Basin, which we've indicated is a flexible portion of our portfolio and have always indicated the strength of Chevron's business was the ability to flex our capital if there were market signals indicating that was the right thing to do.
So if you cut Permian, what does that then mean for Permian production? And how quickly do you feel the CapEx shift in the Permian to actual takeout rates?
Yeah, so we were guiding this year to capital spending in the Permian over $4 billion. We've reduced that by $2 billion. So think about it coming down by half. Permian production earlier this month at our Investor Day, we had indicated would exit the year somewhere north of 600,000 barrels per day. We're bringing that number down by about 125,000 barrels a day. So a significant impact from what we had laid out just a few weeks ago as we stand down rigs, stand down completion crews, and really ramp activity in our most flexible asset class to a much lower level.
Can you give me some insight, Mike, into how you're thinking of the oil price trajectory, as if we stay in the 20s for X amount of months, then we have to revisit our CapEx spend in these areas?
We certainly look at a number of scenarios, Alix. Oil price is maddeningly difficult to predict in normal times. It's impossible to predict in times as uncertain as those that we're in right now. Demand clearly is off in some parts of the world very dramatically. It's not clear when we'll see economies open up and restart and demand return. And at the same time, we've got this surge of supply that had been previously held off the market in Saudi Arabia and Russia and some other countries. And so markets work. We have a mismatch between supply and demand. The price signal suggests less investment, less need for near-term oil. And certainly that's how we're responding. And I think we're seeing others do that as well. Markets respond to those signals also. It can take some time, but we can't predict how long it will be. So we control the things we can control. We've seen situations like this before. We know what to do, and we're doing it.
Part of, though, the question I think the street has with all the big oil companies is at what point do you have to cut your dividend, for example? How long can you sustain your dividend at these prices?
Yeah, our financial priorities are unchanged. The dividend is our number one priority. We've actually increased our annual dividend payout for 33 consecutive years. We haven't cut our dividend since 1934 in the depths of the Great Depression. And so we've got a long track record of a secure dividend and recently a 3-decade track record of a growing dividend. And we're very mindful of that. We came into this environment with the strongest balance sheet in the industry, the lowest break even in the industry, and we're taking strong actions to preserve cash today, not just with the capital spending reductions, but with the termination of our share repurchase program and the continuation of efforts that we have already announced to further reduce costs, improve margins, and improve efficiency in our underlying business. So all of these are measures that align with our financial priorities, preserve long-term growth, but sacrifice in the short term in response to the market. But we feel very good about our track record on the dividend, and it continues to be our top priority.
So now I'm going to ask you the question that you probably hate more than the dividend question, and that is the M&A question. So at this point, Occidental is trading below the price of Anadarko when you bid for Anadarko. Do you have a shopping list?
You know, we've moved on from that, and we're taking the actions, Alix, in response to today's market to keep our company strong and healthy and viable. Strong, healthy, viable companies have opportunities over time to acquire assets or other businesses that may make sense. We've always said that's a high bar, and we like our portfolio. It's one of the reasons we'll be able to navigate through this well, is because we have a strong portfolio, and we intend to stay strong. And we'll leave opportunities and shopping discussions for another day.
Well, just one quick follow on that. When you talk about the high bar for an acquisition, is the high bar the price or is the high bar the asset?
Well, it's really it's asset quality as compared to what we already have within our portfolio. We have a strong portfolio, and anything we would add wouldn't be just because we think we could buy it at an attractive price, but it really would be because we think those assets make us a stronger company. They build long-term value for our shareholders. They would compete for investment within our portfolio, and they strengthen our value proposition over the long term. So that's what we'd look at. That's always what we look at.
Mike, for the broader macro question, do you feel like oil at 25 is a demand or a supply issue primarily?
Yes, it's both, Alix. It's the market saying we've got more supply and less demand than would balance somewhere near the actual marginal cost of production. And so it's clearly a market signal saying that it's a market that's not in balance, and it disincentivizes supply from higher cost suppliers, and it encourages consumption of energy. Unfortunately, given the economic situation globally right now, low oil prices really don't have much of a stimulative effect on the economy because there are other forces that are suppressing that demand. And I think that's what makes this price cycle more unpredictable, is we don't have as much of a track record with how the economy moves through a period of these shutdowns, recovers from a pandemic of this nature, and moves forward. And so it makes it tricky to try to predict price.
So I guess I ask because on the demand front, there's nothing you can do about that. Basically, the virus needs to sort itself out for demand to actually kick up and economies need to reopen. The supply side is different. The Texas Railroad Commission said that maybe the Texas players should join with Saudi and Russia to cut 10% of output. Are there any conditions you could ever see where you would voluntarily cut production with those two countries?
Well, you know, as an American company, we can't coordinate production cuts with anybody, with any companies or countries. And look, we just talked about the fact that we are reducing production in the Permian Basin by 20% versus what we outlined just a few weeks ago, because we're making choices within our capital portfolio. You see other companies doing similar kinds of things, and it's in response to the market. It's a market signal that suggests that the market doesn't need more short-term oil, and I think people are taking the actions that will respond to that. Discussions between other political entities may or may not occur. We can't depend on that. History says that takes time, so we can control the things that we can control. We know what to do, and we're doing it.